If you hold silver right now, or even think about it every other minute, this video will change the way you see the metal and maybe change the way you see the entire macro landscape. Because what just happened in the silver market isn't just another green candle on a chart. It's a breakout that has shaken every corner of the commodities world and put technicians, institutional players, and even geopolitical strategists on high alert. In fact, silver recently blasted past the $77 level, holding near $78.80 per ounce, one of the fiercest moves in decades, driven by a rare alignment of technical momentum and real physical market stress. Now, let EUS be clear. This isn't your typical cyclical uptick during a soft dollar environment. This move has multiple engines firing at once, and most public conversations only scratch the surface. Behind the headlines, there's a convergence of industrial demand, supply squeezes, monetary shifts, and positioning dynamics that are pushing this breakout well beyond casual narrative. And yet, even with all that noise, it's still underrated, misunderstood, and in many ways only half explained by mainstream market coverage. To set the stage emotionally, imagine suddenly realizing a quiet corner of the economy has been bleeding scarce supply into an ever-expanding demand engine, and you are only just noticing. That's where silver stands today. Let's start with the basics that drive this particular breakout: technicals and structure. When a commodity like silver trades through a historic resistance zone and refuses to turn back, that's not just noise, it's structural. Silver's breakout past the 77 mark did exactly that, breaking multi-year ceilings and entering uncharted technical territory. Price action in the past month alone shows silver rising nearly 26% and up more than 150% year over year, eclipsing not just expectations, but pretty much every institutional forecast published before the move started. But here's what 99% of commentary glosses over. This breakout is not purely random, and it's not a function of short-term speculation alone. There's a latent structural deficit the market has been carrying for years, a deficit now manifesting in real physical tightness, not just futures pricing swings. Recent analysis suggests inventories in key hubs, from London to Shanghai, are hovering near multi-year lows, even as demand continues to climb in high-growth sectors like solar, electric vehicles, and advanced electronics. And that's where the story starts to get emotional. Because for years, silver was treated like a sidecar asset, something you mention after gold, or in between talking about macro hedge strategies. But today, its dual identity, precious and industrial, isn't just a talking point. It is a core driver of price action. Nearly half of global silver consumption now comes from industrial uses, tied directly to cutting-edge technology and renewable infrastructure, not jewelry or hoarding. So imagine this: industrial demand skyrocketing, inventories tightening, and a metal critical to both energy transition and high-tech manufacturing suddenly caught in a bottleneck. That's a legitimate narrative playing out, and it's backed by hard numbers, not hype. Yet, this story gets even more complex. Because while some analysts are shouting about a structural bull market and the possibility of triple-digit pricing, others are quietly warning about volatility, forced selling, and index rebalancing pressure. Yes, you heard that right. Right in the middle of this breakout, there's a counterforce, a much underestimated one, coming from the very institutions that track commodities as benchmarks. Major index rebalancing in early 2026 could trigger forced liquidation of silver positions, technically pushing prices lower even while the structural story remains bullish. This tug of war is exactly what creates both opportunity and confusion for markets right now. This is where the emotional arc changes, from excitement to anxiety, then back to curiosity. Let's talk about that tension. We have bullish momentum that is technically confirmed, pushing prices upward. But simultaneously, we have systemic selling pressure from benchmarks and funds that must balance their weights across hundreds of commodities, which, ironically, could create short-lived dips in price even as the longer trend remains constructive. Again, that's the kind of paradox that makes this market not just interesting, but psychologically tricky. Now, for some of you who follow sentiment forums or trader chatter, you've probably seen some of the darker or more optimistic scenarios floating around. There are voices calling this a classic squeeze, where forced short covering accelerates the move towards levels that defy most institutional price targets. Other voices warn that the current froth could lead to a dramatic pullback if fundamentals done catch up with price action. This dichotomy isn't just noise, it's a reflection of the market's fragmented structure: paper silver versus physical availability, retail enthusiasm versus institutional caution, technical breakout momentum versus macroeconomic frontiers of monetary policy and rate expectations. Here's where the human part of the story kicks in. Markets are not machines, they are narratives, emotions encoded in price. And silver right now sits at a crossroads of fear and desire. Fear because mainline banks and strategists are urging caution. Goldman Sachs, for example, recently highlighted that while the run has been impressive, Extreme volatility and structural imbalances could keep prices swinging wildly, not steadily upward. Desire, because the narrative of scarcity meeting industrial megatrends is one of the most powerful long-horizon debates you can have in commodities today. And that's why even the analysts are confused. Some banks project silver averaging modestly higher as part of 2026, while others suggest a possible spike into 3 digits should certain catalysts align, like continued deficits, deeper physical tightness, or accelerating technological demand. So what is clear, beyond price charts and headlines, is this. Silver's current ascent is an akiskioti, a simple trend. It's a story of conflicting forces, each credible in its own right, each powerful enough to define the next chapters of this market cycle. From a technical perspective, the breakout past major resistance zones is confirmed. From a fundamental lens, structural demand and supply dynamics are tightening. From a macro perspective, monetary policy, dollar strength, and safe haven flows are all playing unpredictable roles. And from a sentiment and psychology angle, the market is as polarized as we've seen in years. And that's part of the reason why people are talking about numbers like $100, even $130 per ounce. Not because it's guaranteed, but because the drivers creating that possibility are unprecedented in the modern silver market. But here's the fascinating twist. Even with all this narrative complexity, most investors still don't understand how these forces interact. The technical charts don't tell the whole story. The supply-demand statistics don't tell the whole story. And the macro policy shifts add a layer most people aren't even paying attention to yet. Silver right now is a crucible of conflicting pressures, and that makes the next moves in price not just likely, but potentially dramatic. I'll pause here, because even though we've covered a lot of ground, this is only the opening act. The deeper interplay between institutional positioning, supply dynamics, and what might happen next when markets respond to forced selling versus real demand is where things get truly interesting. And that will tie directly into part 2. But before we move on, ask yourself this. When a market faces both structural deficits and mechanical selling pressure, which one wins? And why does that matter more than just a target price like $150? Those aren't rhetorical questions. They are the current battleground of silver markets right now, and the emotional tension between them will shape what comes next. Now that you're deep inside the silver story and beginning to feel the tension between structural demand, supply bottlenecks, and contradictory analyst voices, let's peel back another layer most people still get wrong. Because part 1 was about why silver moved, but now we need to talk about why this move matters in ways that almost nobody in the mainstream is fully positioning for. And more importantly, why the next few weeks could be disorienting, even for seasoned pros. If silver's breakout was the shocking headline, then what's happening now, especially the market, internal structural shifts, is the real story that could make or break this entire cycle. Have you noticed how pundits keep saying silver is volatile? That price swings are unpredictable? That the current rally could just be a short-lived spike? That uncertainty is not a mistake in coverage. It actually reflects a deeper fragmentation in the silver market, one that most participants don't even realize exists yet. Here's the truth no one tells you right away. There are 2 silver markets right now, the paper silver market you see on charts and futures screens and the physical silver market, the actual metal in vaults and hands. These 2 markets have diverged, and when that happens, confusion becomes the norm, not the exception. Think of it like 2 parallel realities. In one, prices are determined by futures contracts, ETF holdings, and speculative flows. In the other, physical metal is being hoarded, used, and becoming harder to source. When these 2 realities pull apart, you don't get a smooth ride. You get swings, pricing disconnects, and narratives that contradict each other as often as they align. That's exactly what's unfolding now. On one side, recent reports because that's the kind of data point that forces analysts to revise models, reestimate valuation, and sometimes change their entire view on where the next leg of the market is driven from. Not charts alone, but where the real metal actually exists and how it can be moved. And yet, there's a contrasting voice in the room. Some major banks, like HSBC, are suggesting that while silver stays strong in early 2026, macroeconomic shifts, like potential Fed policy changes, dollar strength, or slowing industrial growth, could introduce significant price pullbacks later. They even project a flattening or moderation of deficits by the end of the year as mining output and recycling respond to higher prices. That is exactly the reflexive contradiction I mentioned earlier. One set of experts says this is the calm before the storm. Another says this storm could be short-lived. You're left wondering who's right? And more importantly, what really determines who's right? It's not just price charts, and it's not just headlines. It's the interplay between physical reality and financial perception. Let me give you another perspective that most financial news doesn't highlight. Major institutions like Bank of America have floated scenarios where silver could realistically spike much higher, far beyond conventional forecasts, if structural tightness worsens and physical shortages become even more acute. Some internal estimates range as high as $135 to over $300 per ounce in extreme conditions. That's not wild price manipulation talk. That's modeling based on balancing supply deficits, demand curves, and stress tests that assume a sustained disconnect between physical availability and paper pricing. But here's the twist that most retail audiences never hear in polished analyst notes. Extreme upside scenarios don't require every condition to be bullish at the same time. All they require is one catalyst that flips perception into reality, such as a major supply shock, a sudden policy shift, or an industrial demand shock where substitution isn't possible. Which brings us to the emotional core of this story, because the average viewer watching a chart only sees price behavior. They don't see physical inventories vanishing. They don't see geopolitical supply policy changes. They don't hear about industrial demand growing faster than estimated models. They just see a quick move up and think, wow, it's high. But what is really remarkable is not that silver spiked, it's that it didn't OMT spike sooner given the scale of industrial adoption and deficits. And that's precisely why even seasoned analysts aren't unanimous. Some feel prices could correct, others see bigger structural breakout potential. That disagreement isn't a flaw. It is a symptom of a market transitioning from being priced as a commodity to being priced as a strategic industrial asset with monetary optionality. So the real question isn't whether silver goes up or down tomorrow. It's when does the physical market overwhelm the paper market? And how fast does that gap close? That's the emotional hook. And it's the real driver of confusion, excitement, anxiety, and opportunity in this market. And it all sets the stage for part 3, where we all dig into specific catalysts that could flip the entire silver narrative from structural imbalance to market-defining event in either direction. Because this isn't just about where prices might go, it's about whether the very structure of silver pricing itself is being rewritten beneath our feet. So now we arrive at the point where most silver conversations quietly stop, and where the real story actually begins. Because if part 1 was about the breakout, and part 2 was about the hidden structural conflict between paper and physical markets, then this final section is about what happens when pressure builds long enough that something has to give. And when markets reach that stage, they don't send polite warnings. They move fast, emotionally, and often in ways that surprise even the people who thought they were prepared. And let's zoom out for a moment and change perspective. Forget daily candles. Forget influencers throwing numbers around. Forget the noise. Think instead about how markets behave right before a regime change. Historically, the most violent moves in commodities don't happen when everyone agrees. They happen when confidence collapses on one side of the trade, when assumptions that held for years suddenly stop working, when price discovery breaks down and emotion takes over. That's not drama, that's market structure. And silver right now is flirting with that zone. One of the most under-discussed catalysts sitting in the background is policy timing. Central banks around the world are approaching a moment where monetary direction is no longer theoretical. Rate decisions, balance sheet language, and currency stability are becoming harder to manage simultaneously. Even small shifts in tone have already created outsized reactions across metals, bonds, and currencies. Silver sits right in the crossfire of all three. It reacts to currency stress like a monetary metal, it reacts to growth expectations like an industrial input, and it reacts to fear faster than most people expect. That triple sensitivity is rare and dangerous because it means silver doesn't need perfect conditions to move. It just needs imbalance. And imbalance is everywhere. In part 2, we talked about China's export controls and regional fragmentation. Here's the uncomfortable extension of that thought. Once supply chains fragment, they don't easily reconnect. Logistics reroute, contracts adjust, pricing becomes regional instead of global. That's how a single spot price starts losing relevance. That's also how volatility becomes structural rather than temporary. Now add another layer most people don't like to talk about openly, trust in price signals. When industrial buyers, the people who must have silver to operate, start questioning whether futures prices reflect real availability, behavior changes. They hedge differently. They secure inventory earlier. They absorb higher costs quietly rather than risk shortages later. That behavior doesn't show up immediately on charts. But when it does, it tends to do so all at once. This is where the emotional tone shifts again, from confusion to anticipation. Because anticipation is what fuels positioning. Institutions don't wait for headlines. They watch flow, they watch inventory data, they watch delivery times. And right now, delivery times and availability signals are flashing something most retail audiences haven't fully absorbed yet. This market is tight, even at elevated prices. That matters more than price targets. A market that struggles to source metal at high prices is overheated. It is constrained. But constraints don't always push prices straight up. Sometimes they create violent whipsaws, sudden pullbacks, false breakdowns. moves that shake confidence before continuing the broader trend. That's how markets transfer conviction from weak hands to strong ones, not by consensus, but by discomfort. Which brings us to sentiment. Public sentiment around silver right now is split in a very specific way. You have one group convinced this is the start of a historic repricing, another convinced it's a blow-off top waiting to collapse, and a much larger group sitting in the middle, unsure whether they're early, late, or already wrong. That indecision is not neutral. It's fuel. Markets don't resolve uncertainty gently. They resolve it by forcing a narrative. Either prices retrace sharply enough to convince people the move was overdone, or something happens that makes the previous breakout look small in hindsight. And here's the part that makes professionals uncomfortable. Both paths can exist in the same larger cycle. This is where the storytelling matters. Because silver's story isn't linear, it's episodic. Periods of explosive movement, periods of grinding frustration, periods where nothing seems to make sense. That's exactly how markets behave when they transitioning from being priced as just another commodity to being priced as something strategically essential. And silver is undeniably strategic now, not because of hype, but because modern infrastructure depends on it in ways that don't allow easy substitution. You can't redesign solar panels overnight. You can't re-engineer electronic supply chains in a quarter. You can't replace silver's conductivity at scale without trade-offs that industries actively resist. That's not speculation. That's engineering reality, which leads to the final unresolved tension. If silver is strategically essential, if physical supply is constrained, if inventories are already depleted, and if policy, currency, and industrial demand are all exerting pressure at the same time, then the real variable isn't how high can silver go. It's how long can the current pricing structure hold before it has to adjust. And adjustments don't announce themselves politely. Sometimes they look like corrections. Sometimes they look like squeezes. Sometimes they look like chaos. What makes this moment particularly uncomfortable and fascinating is that no single group controls the outcome. Not miners, not banks, not governments, not traders. Each group is reacting to the others, often with incomplete information. That's when markets become reflexive. Price moves influence behavior. Behavior influences supply. Supply influences policy. Policy feeds back into price. That loop is already forming. And once a reflexive loop gains momentum, traditional valuation models start breaking down. Analysts widen ranges. Forecasts become conditional. Language shifts from certainty to probability. You've probably noticed that already. More phrases like could, may, if conditions persist. That's not weakness, that's honesty. Because silver right now isn't a clean thesis, it's a live experiment. An experiment in what happens when a metal that sits at the intersection of technology, energy, and money runs into real-world constraints. And experiments don't end neatly. So where does that leave us emotionally? Some viewers feel excited, some feel nervous, some feel like they've already missed something. Others feel like they're being set up.